and welcome to this edition of Sionic's Fraud Talks. My name is Gareth Evans. I'm Head of Fraud with the Financial Crime and Compliance Practice at Sionic. For those of you who might be new to Sionic, we're a specialist consulting organisation based in the UK, Europe and the United States. We work with many of the world's leading banks and financial services organisations to deliver technology and process improvements across a range of business areas. Some housekeeping before we begin. This session is being recorded and will be made available for those who wish to listen again or who are not able to join us in person today. We'll send you details of how to access the recording after the session. There's also a question and answer session towards the end of this discussion. Please feel free to submit your questions to either myself or today's guest via the Q&A tab in the webinar below. In this latest episode of Sionic Fraud Talks series, we will be discussing the challenges we face in transaction monitoring with guest Constantin von Altrock from IBM Safer Payments. Constantin is CTO of Safer Payments, IBM Director, an IBM Distinguished Industry Leader, IBM Industry Academy member, pioneer, inventor, and leading subject matter expert in payment fraud prevention and financial compliance using machine learning. Constantin is the author of popular textbooks and scientific publications in the field of AI, is currently implementing financial fraud prevention systems with marquee customers around the world. Constantin was also the founder of the company that became IBM Safer Payments after acquisition in 2015. On a personal note, in the preparation for this session, I realized that our paths have crossed many times, but we've never actually met in person. So it's a real pleasure to be speaking with Constantin today. Constantin, welcome.
Thank you very much.
Right, in last month's Fraud Talks, we discussed behavioral profiling. This time we're looking at transaction monitoring. So just to get everybody up to speed, Constantin, what's the difference between behavioral profiling and transaction monitoring?
That's actually a good one, Gareth. People in our industry often use these terms rather interchangeably, even though strictly speaking, they mean something quite different. So in our industry, we use the term behavioral profiling to describe any kind of analysis of data to interpret whether a certain activity is criminal or, in our case, fraudulent. This may include looking at transaction sequences, but it typically includes many other data elements. For example, reference data about entities, people, devices, institutions. So the term transaction monitoring usually describes the much narrower case of looking at a series of similar actions, for example, payments of an account or a card. As I said, and people in our industry often use these terms rather interchangeably, and what we do in payment fraud prevention is typically including a bit of both. Profiling payment transactions of a customer over an extended time allows us to understand typical, thus genuine, behavior. So we can detect if all of a sudden payment transactions are made that are highly unusual for this specific customer. For example, if we have a customer who basically uses his card for gas and food only, and all of a sudden his activity shows multiple internet gambling transactions, we would become pretty suspicious. At the same time, we also profile transactions of known fraud cases. So this allows us to understand typical fraud patterns. For example, we may see that fraudulent purchases of expensive electronic items are preceded by a few test transactions. So small amount purchases at convenience stores, gas stations, for example, that indicate to a criminal who obtained illegal access to our customers' card data, first checks if this card is still valid before, for example, he goes into an Apple store to buy 2 iPhone 11 Pro. So the key to efficient fraud prevention is to actually profile both types of behavior from transaction sequences. You need to detect if current behavior shows closeness to known fraud patterns. In other words, if current behavior shows high-risk transactions, but at the same time, to keep the numbers of false alerts low, you have to also profile what behavior is normal for each customer. And this has to be individual for each customer. What is normal behavior for one customer may not be for another. So only when you balance out the incriminating factors against the exonerating factors, you will get a good combination of both hit rate and false positives.
Okay, excellent. So we've both been doing this for quite some time, working in this industry, and certainly when we began this journey, the number of payment types was fairly limited. You know, you kind of had check, and we had sort of cards, plastic credit cards, and so on. But we've got more payment types than ever today. Open banking, PSD2, cryptocurrencies. We've seen the big tech giants coming into the payments market. Fintech and payment providers. We've got different banking schemes out there, as well as the traditional debit cards and credit cards and bank transfers that we've been looking at for some time. Surely there's a growing challenge for banks and other payment processing organizations to manage these different product types. And how do banks tackle this? How do they go about tackling the problem of payment transaction monitoring when you have such a diverse range of payment types?
You just described the issue very well, and this indeed is of high concern to most of our real-time banking customers. In the good old days, when a new payment instrument was introduced, it took many years, even decades, before criminals attacked and defrauded them. Back then, banks had ample time to build up all the fraud defenses they needed after they deployed the payment instrument. That world is gone and it's not coming back. Now criminals will attack immediately. So they're forcing banks to have fraud prevention in place from day one. And here's the challenge with all these innovative payment systems. Banks have to design fraud prevention before they even know what kind of fraud they would be facing. Some examples. I mean, when Apple Pay launched, most of the initial fraud occurred at the onboarding mechanism of the individual banks and card accounts. That was not easy to anticipate before it actually happened. And another example, the Zelle system in the United States. When Zelle launched, most of the initial fraud was not with the security of the payment system itself, but much rather was leveraging the lack of experience of the users. What was designed by the banks as a payment system between people that know each other very well in the real world, criminals have used it for e-commerce type transactions between strangers. So banks more and more are moving away from traditional fraud prevention systems to much more flexible platforms, where they can completely reconfigure a fraud prevention strategy within only hours, not even interrupting the 24/7 operations. So they're moving away from systems that rely on a vendor to create fraud prevention models to flexible platforms that enable their own stuff, both business experts and data scientists to adapt fraud prevention to emerging fraud patterns immediately and, if necessary, within only hours.
Okay, and I guess that's where the concept of omnichannel fraud or cross-channel fraud comes in, which I've heard about for quite some time, but I haven't seen it used that often. In that, I still see a lot of organizations keep their card fraud or card business and their non-card business, their sort of wire payments and so on, separate. And I think a large part of this is the different challenges that you have with both around things like latency and customer treatment strategy, risk appetite, and so on. Is omnichannel cross-channel fraud realistic, and how do you overcome the different challenges that you face with the different payment types?
You're spot on. Let me first start with the good news and directly answer your question. Is omnichannel and cross-channel fraud prevention realistic? Yes, it is realistic. But it does require moving away from the silo-oriented point solutions that we have today to true enterprise price platforms. And as you said it very right, there are many challenges with that. So one challenge is the capability of the fraud prevention platforms themselves. Profiling transaction behavior with cards, for example, is very different from profiling transaction behavior in real-time systems or with PSD2. With cards, you always have an issuing side of the transaction and an acquiring side of the transaction. And for practical purpose, money always flows into one direction. So you profile a cardholder in his behavior of sending or spending money, and you profile the merchant, terminal, or ATM on the other side in its behavior of receiving money. With real-time payments, PSD2, and any kind of peer-to-peer payment system, this situation immediately becomes more complex. There is no issue and acquirer side anymore. You rather only have entities, customers, companies, and they can be an originator in one transaction and a recipient in another transaction. So we experienced this first when we provided fraud prevention for the UK faster payment systems when it went live in 2008. To disguise the true flow of a large amount payment transactions, getting fraudulently obtained monies into their hands, these criminals split up the total amount into multiple payment transactions, routed them over Mule accounts, sometimes even over multiple stops. And that made our live fraud prevention very difficult. If we do not even know the true originator and the true beneficiary and the true amount of a payment transaction, we have nearly no chance to defend fraud efficiently. Therefore, we had to develop a new technology that we call peer profiling. So in peer profiling, we take the originator in the current payment transaction and both profile him in his past behavior as an originator of other payment transactions, but at the same time, we also profile him in the past in his behavior as a beneficiary in other transactions. And we do the same for the beneficiary of the current transactions. So this provides us with a total of 4 historical dimensions for behavioral profiling to assess the current transactions. It allows us to understand the true originator, the true beneficiary, and the true amount of the money of the payment transaction in real time. And it also at the same time allows us to detect Mule accounts also in real time. So these are some of the challenges of implementing omnichannel fraud prevention to detect cross-channel fraud. The interesting question now is it worthwhile? And oh yes, it is. And both for detecting more fraud and also at the same time to reduce customer friction caused by false alerts. Let's look at some examples. So assume you are a bank in the UK and you're looking at a UK customer. All of a sudden, you get a real-time outgoing payment instruction initiated from an online banking session with a Malaysian IP address to a beneficiary with a Malaysian banking account. Your online banking history in your silo, in your channel, never shows anything like this before. Would you stop this transaction? You probably should.
Possibly, yeah, I'm not sure.
At least you want to put it into a suspense queue, right?
Absolutely.
If, however, you would have an omni-channel fraud prevention platform, you would also have, for instance, credit and debit card data.
Yeah.
So let's assume on the credit card records, you would find a rather expensive airline ticket purchase 3 weeks ago. So you can conclude it's not an inner-European flight. And unfortunately, the credit card data will not tell you if this was Heathrow to Kuala Lumpur, but still you can assume that there's a good chance your customer is far abroad. Yeah. And then maybe you see recent restaurant charges, taxi charges from Malaysia on the debit card records. Now you can safely assume that your customer is legitimately in Malaysia, and all of a sudden his online banking initiated real-time payment does not appear to be so much out of the ordinary anymore. And by not intercepting it, you can avoid a false alarm. So reducing friction is only one benefit of the omni-channel, cross-channel fraud prevention approach. And another one is to prevent some of the most damaging fraud schemes there are. We have one customer in Eastern Europe that is regionally close to some of the most creative groups of criminals in the world. And when you look at these opponents, you will not talk about organized crime anymore. You will talk about well-organized crime.
Yes, yes.
Groups attack. They're out for the large scale and massive total fraud amounts. So in my customer's case, this well-organized crime group was attacking their online banking. And it was pretty much the usual type of attack, malware, Trojans, phishing, etc., just to obtain online banking account credentials. Then they launched an orchestrated attack to drain funds from all of these compromised accounts. Now, the problem is, because of the sites, if they would take all these monies directly out of the bank, this would have become way too obvious too quickly. Yeah. So what they have done is, they have used another team to obtain full access to a set of Mule accounts. Yeah. Accounts that were opened with falsified credentials or accounts that were bought from migrant workers that left the country forever after they've built up a multi-year history of legitimate transactions. And very hard to understand that they are Mule accounts. Yeah. So they now moved all the stolen funds from the online accounts they attacked to those Mule accounts. And they had cards and all the credentials of these Mule accounts. So they were using the cards at ATMs to get cash, which criminals love. Then when they reached the limits, then they would start buying iPhones with the cards to sell them on the street for 80% of the shop price. And eventually they were transferring the remaining funds to countries with an intransparent banking system. So the only way you detect and prevent such fraud attacks is to have an omnichannel fraud prevention system that lets you profile customer behavior throughout all of the payment instruments, and at the same time also follows the flow of the money between the channels.
Yeah. So presumably that kind of sophistication requires machine learning and AI as opposed to a rule-based system. How effective have you found machine learning and AI techniques to be? That's one example. Is it only possible through machine learning, or can this still be done through rule-based systems?
The entire discussion whether rule-based is better than artificial intelligence is, to most of our customers, is irrelevant. They found that a clever combination of both is getting them exactly what they need. So if I look at our own fraud prevention platform, Safer Payments, it is entirely based around machine learning and artificial intelligence. And our clients use the entire spectrum of our Watson Studio offering, and they're having huge success with that. Yet it is important to notice that there are three other key elements that our clients found to be essential to get both massive fraud loss reductions and much lower false positives. And number one, as you mentioned, is rules, decision rules. Typically, our clients use more than one machine learning model to create scores for different types of fraud. How those scores are best applied to a certain transaction is often best expressed by decision rules and policy rules. And being able to quickly adapt these rules to fast evolving fraud attacks has been found of key importance by our clients. To support this, we have even developed a specific artificial intelligence that assists our clients to quickly adopt these decision rules to fast changing fraud patterns. So that is number one. Number two is behavioral profiles, or as the data science like to call them, features. Yeah. Now, there is a huge academic discussion on what machine learning model performs best. Our clients find these differences mostly irrelevant. Yeah. What they find, however, is that the capability of creating behavioral profiles, features, that are highly descriptive of a customer's behavior and of a criminal's behavior, for that matter, is much more important. In other words, if you have high quality features, pretty much any machine learning model will get you great results. And number three is tooling. For example, we have created a fraud prevention platform that allows our clients to experiment with hundreds, millions of payment records on any kind of machine learning, artificial intelligence, and set of decision rules, and get results nearly immediately. And that just turned out to make these teams highly effective. So lessons learned, it's not all the magic of machine learning and AI, even though this is an essential technology, but just make sure that you get the other things right as well, and then you will get the results you're looking for.
Excellent. Yeah, it's interesting you say that. Because the last few years, the data scientists have become kind of the rock stars of the industry, and I guess that's also led to the so-called citizen data scientist. And there's always been that debate about how much of data science and machine learning is actually the machine algorithms, and how much of it is the ability to identify the data, build the features, do the feature relevance, understand all of that, and whether the citizen data scientist of being able to point and click with a machine versus actual data science to understand how you build that data and how you get that data into the machine is quite key. So how have you found that?
Well, let me start by saying that fraud prevention is probably one of the earliest major adopters of data science and machine intelligence technology. However, at the same time, it's quite different from the other fields where data science is applied. I often talk to young, talented data scientists right from college that are new in our field, and I explain that it is quite different from, for example, predicting if a volcano is going to erupt, because the volcano is not actively trying to hide its intentions. In payment fraud prevention, you have a real opponent. The criminal, on the other side, takes huge effort to hide his activity exactly behind the activity of the legitimate customer. At the same time, I'm explaining that in payment fraud prevention, success is often only short-lived. If you are a data scientist, and if you're really good, and let's say you create a fraud detection model that prevents 90% of the fraud, deploying that you're taking away 90% of the proceedings of a criminal who also has a family, and in turn will use all his creativity to work around your model. So this is a very dynamic relationship. I sometimes compare it with the spy versus spy from stories from Mad Magazine, looking at the color of your beard. You may remember it from the
yes.
But coming back to your question on whether data scientists will still be needed, or if artificial intelligence has become so powerful that it does not need them anymore. So all our clients' experience points into the same direction, and this is that the quality of the data scientists is and will remain a key factor in the performance of the fraud prevention operation. And not just the data scientists, it's also the domain experts. With all the attention to the data scientists, the domain experts have almost become overlooked these days.
Yeah.
And any first-class fraud prevention team also needs domain experts that have a true understanding into how criminals work, think, and devise and deploy their fraud attacks. In the perfect world, the data scientists over time become part domain experts, and the domain experts over time become part data scientists themselves.
Yeah, interesting. Very, very interesting. So I think, where was I going to go next? So we've talked quite a lot about this sort of transaction monitoring, and most of the examples naturally sit within retail banking because of the types of transactions that come along and the types of users, the types of fraud that we identify. How does this then translate into other banking environments? So banking, business banking, corporate banking, wealth and international banking, maybe even things like asset management and share dealing and cryptos. Does the same principle translate, or are there different challenges?
Well, absolutely, yes. The same technologies are successful in these fields to different degrees. And the expertise of my group is mostly in the area of financial fraud. So this will include things like customer risk rating, from starting onboarding a customer through his entire lifetime, and of course to supervised financial compliance. And all the things I talked about in transaction monitoring before and understanding behavior have a direct application in detecting money laundering, for example. So it's just different patterns that we see, but the kind of profiling for behavior or the way we do transaction analysis is very similar in anti-money laundering compared to payment fraud prevention. Okay.
And again, you mentioned identifying the fraudsters and running analytics against the fraudsters themselves. One of the challenges that I've certainly found with some of the organizations we've worked with, especially in some of these kind of wealth management, asset management, is quite often there's an absence of fraudster, or an absence of fraudster data, at least, because it hasn't necessarily been discovered. So it kind of takes us into this whole supervised learning versus unsupervised learning route. How do you find that working?
It's an excellent question that is difficult to answer. Let me try. So first of all, payment fraud prevention is probably, from a data point of view, the most beautiful use case there is. We have 100% accurate training data. Why do we have that? Well, because to us, I mean, we're talking about fraud prevention, but what we're actually do is loss prevention.
Yes.
If there was fraud that our customer hasn't detected, we have no way of preventing it because we don't know about it. But at the same time, it at least is not a financial loss to our client, the financial institution. And at the same time, if a customer commits friendly fraud, so he just pretends that a transaction was fraudulent while it was not, then we still want to catch that and intercept with that because it is monetary loss. And because we usually know exactly which transactions have successfully been disputed by the customers, we know exactly which were the transactions that we should have never allowed to go through. So we have a near perfect data situation. So this is the ideal field for supervised learning. And whenever you have this data situation, supervised learning is always more powerful than unsupervised learning. The problem starts if you go to near fields. For example, money laundering. In money laundering, first of all, you never find out which really was money laundering and which was not, because the FinCEN or the other government institutions never give exact feedback. And if they give exact feedback, or if you learn about a case, then it is years after the fact, and you don't need data which is years old. So you have to use proxies as a target variable for your training. For example, you create alerts, you forward these alerts to investigators, and then you record whether these investigators have actually created, for example, SAR filings out of it. So this is not, so at least if you can use that for learning, you will learn what cases your investigators will deem risky enough to raise it to an alert to the authorities. So there you have a proxy, but the problem is you can never look at 100% of your transactions. So you always have to apply a very rough filter. There is a set of standard AML rules known all over in the world, and they create alerts. And out of these alerts, you may have 1 out of 200 of these alerts will actually result in a SAR filing. So this is something you can train, but you will never be able to understand if there are fraud patterns where the criminals were clever enough to hide underneath all the threshold of these rules, because analyzing that is prohibitive basically because of the pure volume. And you need to do this manually with investigators. It's not like in payment fraud where your customers are sort of your source of information.
Yeah.
So if you then move into things like insurance fraud, for example, that's where it gets really, really difficult, because you typically never know whether a certain case was fraud and not. And even if you get a claimant to withdraw his claim within an insurance case, you may have just exhausted him and it may still have been a legitimate claim. So the data situation goes down from payment fraud prevention more and more. And the less good your quality or your target data for training is, the more you have to consider things like unsupervised learning. Scientifically, all the algorithms that do unsupervised learning are much more sophisticated and interesting. And if you publish articles, that's where you want to be. Compared to that, supervised learning is almost a little bit boring. But I would say from the successes I've seen of unsupervised learning, I've seen a few very promising things, but there is a lot of work before this becomes to be as useful as supervised learning, for example, in payment fraud prevention.
Excellent. Okay. I'm noticing that we've come into the half-hour mark. This is roughly where I start asking questions from the audience. So if anybody does have any questions they'd like to pose to either myself or to Constantin, then please do complete the questions in the Q&A section. I'll ask 1 or 2 more of my own questions while we wait for some others to come in. Let's see. So actually, you've talked quite a bit about Mule accounts, and I think that's quite interesting because one of the things that always used to frustrate me as a kind of a fraud prevention professional was that I always felt that we were playing defensively. We would be defending against the fraudsters who would be constantly attacking the organization. They would be constantly trying to break in, and we would also constantly be defending against that, but we would very rarely have a chance to take the fight back to them. And it's you know, like they say with the security services, you can stop every threat every time, but if that one goes past, then you have a problem. And it was always like that we were always monitoring the fraud, trying to stop the fraud attempts, but very little could we do to disrupt them. Whereas Mule accounts, to me, is an area where we can disrupt them. Mules are key to the criminal's ability to get away with the fraud, but they're the one area where there's a real tangible part to their organization, and they might be mules that have been set up themselves. It might be where they've purchased accounts, or they might be recruited mules where they've got somebody to answer a question, an advert that said, make money from home, and I'm going to send some money through their account, and then they forward that on. But either way, there's always a physical entity there for a mule, and typically those mules are within your organization because they want to take the money from the victim into the mule account in the least risky way possible, and then use the mule account to distribute the more risky transactions. So how does the machine learning or the transaction monitoring around muling, how effective has that been? And have you got examples where you have been able to fundamentally disrupt criminal activity through mule detection?
That's an excellent question. Mule accounts, some of our customers have the policy that when they detect mule accounts, they even go after them without seeing them to be part of a larger fraud scheme. Frequently, it can also be useful to utilize mule accounts to find a larger scheme. So we have one customer in Eastern Europe who basically has a mobile payment system and is using about 200 ATMs, mostly for cash in. This is operating in very much cash-oriented economies. And they had, this was in Russia, and they had a new attack, a new fraud attack that has never been there before. And this fraud attack was with falsified banknotes, dominantly 5,000 ruble notes. 5,000 ruble notes is sort of the standard, most common denomination. It's about, I believe, 30 to 40 US dollars. Okay. Now, they have falsified huge amounts of these money. And even I, not being a specialist in banknotes, can easily see that it's a fake banknote. Now, why is that good? Well, because it hasn't been optimized for the human eye. These false banknotes have been optimized for scanners. So for the first time, banknotes have been falsified to trick machines rather than humans, because all these ATMs all over in Russia use the same brand of scanner. So they only had to optimize it for one brand of scanners. And so now they have flooded the system with false banknotes. And many of the financial institutions in Russia had to shut down business because they just couldn't defend against that. And with our customers, we found a way to do that. And the interesting thing is that we had the same cash scanners, so we couldn't really detect whether they were false banknotes. But what we detected is what happened with the money. So this basically was an electronic wallet system. So what we have seen is that the criminals have used multiple of these ATMs at certain times, certain domination combinations. The accounts all had certain similarities, but it was just vague. It was too vague to actually make decisions about that. So the decisive factor is that we have seen that they have been collecting all these charged up wallets money onto some collector accounts, mule accounts in other words. Yeah. And from those mule accounts, then they have started to extract the money otherwise. And because we could see all these streams of money flowing into the mule accounts, we could let all of this happen. And we only stopped the transactions when they were leaving the system. In other words, before the money was leaving the system. And by that time, we have followed the money so long over these mule accounts that we were almost certain what was fraud and what was not. So our customers could keep basically their operations open and still accept money, while most of the other financial institutions for weeks until the scanners were recalibrated had to stop business. So I believe that is one of the most striking examples that I have ever seen in my career on how you cleverly use analysis about mule accounts in real time to defend fraud.
Excellent. So we have had some questions coming in. It's an interesting one for yourself. I'm sure you can unashamedly promote yourself here. But are there interesting companies working in either the supervised or unsupervised learning space for fraud transaction monitoring?
Well, of course, being from IBM, I believe we are a company that has early been very clear about the potential of this technology, has been promoting this with very visible projects and also with tangible products. And our offering, Safer Payments, is one of that. However, it seems that all big tech companies have by now understood the potential of this technology. They're working in all kinds of fields. To me, being a veteran in the field of AI, I started in '84 at HP Research Labs in Palo Alto. And I would have never thought that we would go as far as we are today with artificial intelligence. Cars that almost drive themselves, even the kind of stuff that we are doing now in my own teams in the 80s, I would never thought that this would be possible. Companies working at that, I really have no good list of that, but yeah. It's all of us big tech companies. And not just as big tech companies, it's also lots of small startups that are doing very innovative work. But I have no good list or anything to share.
Yeah, I guess to kind of slightly change the question a little bit. Obviously, the technology is only as good as the data that comes in, and there's been a rise in smaller kind of point solutions that do maybe one or two things very well, and that might be, you know, to do with malware detection or phishing detection or behavioral profiling or something like that, and that can augment the transaction monitoring. Has there been any interesting technological innovation that you've seen recently that has made you think that's really clever and that could be a really useful addition to a data source?
Well, I have recently been quite impressed by the work that I've seen from a number of startups and also our own teams on biometrics. That has surprised me how well they were able to find me being on my computer versus somebody else being using my credentials. I've seen some demonstrations and I've looked into that and I was pretty impressed, and it gives me high hopes because as more and more of our business is going digital, we need these kind of technologies that even work with remote access. Now, one of the major problems is that, particularly for our customers, when they want to procure a payment fraud prevention platform, these platforms typically stay in operations for more than 10 years. Some have even been in operations for more than 20 years now. Now, we're given this huge amount of innovation that comes from machine learning and artificial intelligence. For our customers, it's the conundrum that at the same time they have to make a decision for a platform that they will be using for 10 or 20 years. They know very well that possibly in 3 years, a technology that nobody even knows yet, which is still going to be invented, and an open source software team that doesn't even exist yet, will provide the kind of fraud prevention technology that they need. So what we have tried to do with our offering is to be as open and as non-ring fenced as possible. So we allow any of these innovative little things to go in, because we still provide the whole platform as a whole, and that will allow our customers to never be sort of stopped in a place where they couldn't participate in the enormous innovation that comes out of this field.
We've got another question, and it's making me smile because I don't think we can have one of these discussions in 2020 and not talk about COVID. But how has COVID affected fraud levels? Is remote working making both retail and investment corporate banking less safe? And if this is the new normal, what does this mean firms need to do to strengthen their defenses?
So what our clients see is that COVID is massively speeding up digitalization. I guess that's obvious to everybody. Now, what this does is it drives many new customers into becoming first-time users of online banking and e-commerce that have rather limited experience with digital and probably would have preferred to not go digital if they wouldn't have been forced by COVID. So this group of new customers becomes what we see a very easy victim for electronic crime. So what we're seeing right now is we see a renaissance of fraud patterns that are targeted at inexperienced users that is quite surprising. I still do expect this to be a short-term effect, and even those new users of digital to become as experienced as the other ones. What we also see and we believe is going to happen over the next year or two is a massive uptake of consumer-to-consumer payment systems and their transaction volumes. So using a mobile to quickly and conveniently transfer even small amounts of money between friends and family will replace cash exchanges substantially. Yeah.
And on that note, actually, I saw Amazon release something the other day saying that they were entering into the fraud prevention market with their Amazon fraud platform. Facebook has obviously been around for a little while, pushing Libra and their kind of crypto version. Apple and Apple Pay we've mentioned before, and Google Pay and so on. You know, there's the globalization of the sort of top half dozen big tech giants. How do you see that changing the industry, or how do you see the battle to come with some of these companies and the resources they have, and where it's going to take, especially where things like machine learning and AI come to the fore?
It's interesting that you mentioned Amazon, Facebook, and Apple that have very diverse ways of entering this market. I mean, let's start with Amazon. Amazon always had its own fraud defenses, which makes total sense if you're one of the largest online merchants in the world. Yeah. And I think it was only a matter of time where they would find good use of also opening this into the public. And I'm certain that the Amazon offering will find their place in the marketplace. What I haven't yet seen from any of these tech giants is that they bring any substantial innovation to the market. So, for example, Amazon's offering is similar to offerings that smaller companies, Silicon Valley startups, and even IBM and other vendors in this field have been offering since 10 years or more. And while their solution may be nicer in certain ways, there's no fundamental innovation in it. Facebook offering a digital currency is also not really a first, and Apple Pay that I use myself is probably the nicest packaging around a credit card. But at the moment, in its essence, that's what it is. It's packaging around a credit card. So congratulations for having found a beautiful packaging around a technology which is 60 years old. Yeah. So I really miss innovation in their offering, which may certainly come at a later point. And also what I'm not seeing is that any of these go into the omnichannel approach that will be most important into the future, even though they may very well expand their offering in the years to come. So it's interesting, but I still have to see real innovative things coming from these very powerful companies with so many talented people.
Perfect. Yes, I've got one more question, and we'll just go for this one. How mature is fraud detection with AI and machine learning today? How long would it take a medium-sized company to develop their own systems and models following these goals?
Well, I mean, you have a huge community of very powerful open source tools in the field of AI today. If you have a large enough, clever enough team, providing a solution that solves your problem now shouldn't take you more than a few months. If you want to bring this into the future, do all the adaptations and all the changes, it eventually will become pretty expensive to do it, to build it out of these bare building blocks. And then maybe you want to look at some of the commercial offerings that will allow you to operate fraud prevention on a daily basis with much more ease, with higher flexibility, higher efficiency, and in the end will get you the better total cost of ownership relation to that. However, that is all very individual. While the payment space is a niche, and the payment fraud prevention space is an even more narrow niche, it's surprising how many sub-niches are in there. And no business case is the same for the various members of the payment ecosystem. And the speed of the development of the market will always allow for new and innovative approaches to find their space.
Perfect, thank you. And just a final close question. Obviously, open banking PSD2 coming along, going to be live this year. We're going to move into the new normal with COVID. Then there's the dreaded B word that we've been trying to avoid for the last few years, the Brexit question. What's your prediction for fraud trends in the next year or two?
Well, given the fact that that we still have a substantial growth of e-commerce and banks that only have direct channel contacts with their customers, it will come from internet-initiated transactions, whether this being on the commercial part with e-commerce or whether this will be on online banking. And of course, we can make these channels more secure by using things like step-up authentication, by things like using number generator key rings or things like that. But the challenge will be to have security systems like ours, which are powerful enough to still have the entire experience to be as seamless as possible. And step-up authentication always means that your better, higher quality fraud defenses have failed. If your fraud detection is perfect, you wouldn't need to have step-up authentication. Without it, you would be able to keep fraud under a lid where it is manageable for your business model. And the same would be true, of course, for online and mobile banking.
Perfect. Thank you, Constantin. And thank you also to all our participants today. I hope you found the discussion interesting. I know I did. So as a reminder, this session has been recorded and will be available for those who wish to listen again or those who are not able to join in person today. We will send you details of how to access the recording after the next session, after this session. We'll also send you details of our next Sionic Fraud Talk on the 10th of September, where I'll be joined by another industry leader to discuss artificial intelligence, machine learning, fraud prevention, and a lot more. Thank you very much, Constantin. That was excellent. Finally, if you'd like to connect with myself on LinkedIn, or I'm sure with Constantin on LinkedIn, please do feel free to send me an invitation. We will include the details on the information that we send you now. Thank you very much.
Thank you very much.